Let's check in quickly on what the outlook for the fixed income markets is. And we've got Ashish Ghiya, who's Managing Director at Derivium Prediction India, joining us on the phone line from Mumbai. Ashish, first up, last week after we saw the half percentage point cut in the repo rate, we did see bond prices rally. We did see the yield come off to the 8.2 levels. Right now, we've seen yields climb back to above 8.5%. So is there a belief in the markets that, high interest rates, at least at the long end of the curve, are here to stay for some time?
The reaction by the bond markets last week was largely in tandem with the guidance that the RBI governor had given. And I think he reiterated the same throughout in post-policy interviews. So yes, market is kind of giving up some part of the initial discounting that they had made, that there will be elongated rate cuts. But this is, I believe, is just a continuation of the pre-policy expectation that was a climb down of how much the RBI will cut rates, even pre-policy. So the reaction last week was just a continuation of that, in my belief.
Sure, but Ashish, inflation continues to remain a big concern, and the RBI has acknowledged that. The RBI has also said that in the event that inflationary conditions get, out of control or again climb back to previous levels, it will not hesitate in reversing the policy rate cut. So is that also something that's weighing on the markets at present?
Well, maybe it does, but ultimately RBI has acted on growth front. I mean, yes, he has got concerns on inflation, and that is exactly what RBI's primary job would be. But he's right now, his policy actions have kind of gone more in consonance with the growth concerns. So I think that will continue to weigh on him when actually policy action tends to come. So I don't believe that, a rate reversal will be in the offing very, very soon. I mean, it kind of looks a little bit out of script if you're hiking rates immediately after or very soon after a 50 basis points rate cut. Obviously, unprecedented events if they occur, but that's a given norm at any point of time.
Ashish, so then how much probability are you attaching to the fact that in June and July also we'll probably see more rate cuts, and how do you believe the bond markets are likely to digest that?
It's too early right now to discount a possibility of another rate cut action in June and July, especially after the RBI governor has kind of reiterated in many ways last week that, this seems one of the last actions. But I believe that markets will start once some more data comes in, markets will start discounting some more rate action from RBI. Maybe not 50 basis points, maybe next time it's a calibrated 25 basis points. But maybe markets will start, I believe markets will start discounting post some macro figures print out.
And Ashish, do you believe that had the Reserve Bank of India actually cut the repo rate by a quarter percentage point and cut the cash reserve ratio by a quarter percentage point last Tuesday, we may have seen yields actually at much lower levels than we are seeing them today?
No, George, they're two different events. What you're asking, let me answer it separately. One is, would the markets have taken a better cue if it was a 25 basis points cut? The question, I think the markets got spooked more by the guidance than the magnitude of rate cuts. Secondly, regarding the CRR cut, I don't really think, the market liquidity is there, and CRR cut seems to be a little bit more, he would rather keep that for some kind of as an arsenal if things go out of hand on the foreign exchange front. If he needs to add on liquidity on the interbank side, he's anyway buying government securities in the secondary market. He can do OMOs, which he's done in the last week of March. So he would rather put in the primary liquidity through those sources rather than CRR cut.
And Ashish, finally, in order to inject more liquidity into the system and sort of alleviate the kind of supply side pressures, what kind of measures are you expecting, and what do you think is really required for the same?
I'm sorry, can you repeat that, please?
What measures do you think will be required to inject more liquidity into the system?
At this point of time, liquidity in the system is okay. It's not something so worrisome. Probably it's a tad higher than what RBI would have liked it to be. But a large part of the liquidity is a rundown of the government balances, which will continue to weigh on the interbank liquidity. If there is a stress again, I believe RBI may conduct OMOs. Probably they're already discreetly buying securities from the secondary market. So I think that is a combination.